Good morning, traders. Welcome to this FOMC Wednesday intraday strategy webinar. Michael Boutros here with you this morning. Great to see everyone in the room. Horace, Kelly, Medad, Mark, Rich, Steven, Sushil, Wesley. Not going to get through everyone, but great to see you guys. So it's a big day on hand. We've finally been waiting for this interest rate decision. We got the BOJ last night. We'll talk about those results and the implications of their move to further ease policy. Obviously on tap today, we're going to cover all the U.S. dollar crosses. So up on tap in this order, we'll do dollar yen, euro dollar, sterling dollar. I do want to touch on pound yen. D is looking at pound yen. Also coming into an interesting area of support. Aussie dollar we'll talk about. Again, there we'll just segue real quick into an Aussie yen scalp we've been following. Dollar CAD. And obviously, we'll start off with the dollar index. So some things to keep in mind. Obviously, we have today's a big day for central bank rate decisions. We do get the FOMC at 2 p.m. Eastern. The subsequent presser with Janet Yellen at 2:30. And not only, she comes on and she reads the same exact statement that was released at 2. So that's not going to be the tell. It's always the Q&A section, which comes right after, where she's questioned by the media, and certainly these questions can sometimes reveal a little bit more about what the committee is actually looking to do. Just a couple of hours later, we get the release of the RBNZ interest rate decision from the Reserve Bank of New Zealand. So we'll want to keep a look on that Kiwi dollar as well. And then later tonight, around 8 p.m. Eastern, you get the RBA Governor Philip Lowe. This is his first time taking over from Glenn Stevens. He's officially the new RBA governor, and certainly he'll be testifying before the Parliament Committee at 8 p.m. today. So we'll get a first taste of Governor Lowe's sort of tone as per policy. He's known more of an inflation targeter. So if that tells anything, we'll see if that kind of follows through his comments tonight. All right, so let's jump into the FOMC preview. D, yes, I got your question. We were speaking earlier. I'll get through all those pairs for you today. D says, I only booked half of my Euro Kiwi last night after the webinar, so running balance to target my initial 49.95. Thanks for yesterday. Hey, well, you're more than welcome, D. Nice hold. Nice hold on that trade. That's Euro Key. Let me jot that down. If we have time, we'll take a look at that for sure. Okay. Wes says, can we look at gold sooner? I have a long position on it. Let's start off with the dollar, Wes, and then I'll take right a look into gold. So let's do US dollar as number 1. And then we'll do gold. And then we'll jump into the pairs, okay? Here's what the Dow Jones FXCM dollar index looks like to start off this session, okay? We're actually seeing that the dollar is weaker against all its major counterparts. Biggest gainer, Japanese yen, up 0.89%. You saw those yen crosses really drop, some of them coming in some key areas of support. Second biggest winner subsequently would be the Aussie dollar, up 0.49%. And you can see here the rest. So big move for strength in the yen. Heading into the FOMC, before I jump into the implications for the BOJ yesterday, here's what the dollar index looks like, okay? The major key resistance level, we ran into it again last night, right here, 12,014 to 12,018. I think the high was 12,022, so we just probed through it before the pullback. Still remains the area of interest for critical resistance and our bearish invalidation level. So as long as price is below this region, I'm looking lower in the index. Initial support, you're looking at the 100-day moving average. Again, the 50% retracement takes you to 11,935, a nice bisector for the range of the month. And again, a downside break from there, and you're looking for a steeper drop. I'll show you the scalp chart in just a moment, but before we do, here's what the Fed Fund futures look like ahead of the release, and here's what they look like yesterday, or here's what they look like now, rather. So we were looking at about a 58% chance for December. That's tightened up a little bit to 59.7. Today's release still steady at 22%. So a very negligible expectation for the Fed to actually move on rates. The focus, as opposed to necessarily the Fed Fund futures, is going to be the dot plot. And this is what everyone will be looking at as we head into the release. So the dot plot here showed that there is a median expectation of 1.25%, okay, for the committee. Each one of these dots represents the committee, one of the committee members' expectation for where rates will be, okay, heading into the calendar year. So 2017, you can see that the last quarterly projection that we got in March, or in June rather, showed that the median expectation for next year is 1.25%. So that would mean we would need a number 3 to 4 interest rate hikes to get us at this 1.25%, right? So they're going to be looking to see if there's any shift. If we see that the median expectation upticks to 1.5 or 1.75 and the majority of the committee sits here, that would suggest a faster rate of increase for the interest rates, okay, or a steeper path of the interest rate hike. If we see that the median expectation starts to dribble lower or some of the committee members drop into a 1.25 range or a 1% range, that would suggest the exact opposite, right? That the committee members are saying, whoa, looks like we might not be able to hike as quickly, okay? So this is what the markets will be focused on. Don't mind all the other noise you're going to hear today because there's going to be a tons of it. Eileen says, in my humble opinion, quote unquote, I think the rates should be raised now so the market could get on figuring out what it wants to do with the election. So Eileen, we can get into what what I think and what you think should happen. I think they missed their mark already. I think rates should have been hiked way earlier this year. Now they've painted themselves into a corner, as you see, accelerated central banks looking to accelerate their easing policies. And this divergence is going to create some inherent problems, not only to mention strengthen the dollar, which again, at its pace right now, it's not a big deal, but it's not necessarily going to be a positive. It's going to be a headwind for U.S. markets. So I agree. The rates belong nowhere near where they are. This is certainly, if you listened to Fisher yesterday, who was on CNBC, I completely agree with his assessment 100%. This is leading to a little bit more excessive risk-taking, and it also, risks certainly a bubble in a lot of different markets. So the best course of action at the Fed, in my humble opinion this time, Eileen, is for them to really come up. And like I said in yesterday's piece, our base case scenario is a hawkish hold. And what I mean by that is they hold rates as expected. No markets are not expecting them to move today, but they come out with a much more hawkish stance and basically start to prep the markets for an inevitable hike. Remember, we do have an interest rate decision in November, but markets have been postulating that it's unlikely that the Fed will look to hike rates on a meeting where we don't have a press conference or don't have quarterly projections. So that would leave the only option in December. It's exactly what we did last year. That's when we got the hike, right? So while there is a November release and we continue to hear the Fed say every meeting is live and we can move on every we can move on any meeting. Again, markets are still betting against that. And even the November interest rate decision is only seeing a 28% chance that we see them move on rates. That's why the quarterly meeting, which would be in December, would have updated projections, would have another presser with Yellen. That's where the bulk of the market expectation is. Okay? If hawkish, Wesley says, if there's a hawkish hold, does it mean that the U.S. dollar will go up to retest resistance? So Wes, I think there's definitely a chance of that. I think I might be interested in fading that move. So on another sort of rally right back into this key resistance, if we start to see a reaction off that like we did last night, a really sharp reaction, that might be another opportunity to try to get back on the short side. This, at the end of the day, remains our bearish invalidation level. So Wes, if it comes out with a hawkish hold and it breaches 12,018, comes back and it holds a support, this thing will be looking for 1260, 12,100, and the US, or the 2016 Open rather, comes in at 12,131. So I'm still working with the technicals, right? We're just going to see what this event risk prompts in the way of near-term volatility. Game plan for me remains unchanged. And keep in mind one important feature. A lot of people are saying, well, if they hold, the dollar will rally. Well, keep things in mind, guys. Markets are not expecting them to hike. So it's not necessary that if they hold, the dollar is going to rally. The dollar is not expecting a hike today. It's all about the commentary and the projections for where we see interest rates moving forward. Okay, this is what the markets will take their cues off of, not necessarily if they hike or not. Okay, Wes, does that make sense? He says, okay, cool. So that's the first thing I'll be looking for today is just to see, and I'll tweet the chart as soon as it comes out. By the way, here's the link for the Fed calendar site. So just so you guys have that on hand, there's the link in the chat box. You can always click on that and get the updated projections. Sometimes the site kind of freezes up right on the release, but I'll try to get that out as soon as possible. So for the dollar index, nothing has changed as far as the levels are concerned. We put out these levels yesterday in the piece as well. Here's what the scalp looks like. You saw a rallying overnight right back into key resistance, our bearish invalidation level, strong hold, and a reversal right back into key support, the weekly opening range, 11,055 into 11,060. That's where we're sitting right now. Okay, so on its face, just heading into the release, it's a clean weekly opening range. Here's your weekly open, tested the low, rejected the key resistance level again, Fibonacci, 100% extension off the low, 618 off the high, beautiful confluence fibs, my favorite. And again, right now testing support ahead of the release. Any questions on the dollar index? So heading into this, if we do break lower ahead of the FOMC, I don't really want to touch it, guys. I'm not going to interpret that as anything special. But objectively, that would be, especially if we close today below this region, an objective break of the weekly opening range. It would shift the focus lower. Okay, moving into gold here for Wes. He looks like he really wants to see that gold trade as soon as possible. Let me bring it up for you, brother. Here's what gold looks like heading into the release. Again, typically a fear and inflationary trade. You're coming off support. So Wes, let me go back to your question here. Can we look at, I'm holding a long position on it. Okay, so your first area of interest for me on the long side of the trade is right here. What's that level? 1330. Okay, that's the low day reversal close that we made for July. You can also see that it was a very clean pivot in price holding the initial August opening range low before breaking on the 24th there. Clean pivots on the way up and down too. So that'd be my first area of interest for sort of initial resistance. Also just higher is that same long-term 2011 trendline resistance off the record highs that we made. And that comes in just higher. So I'd be looking for a near-term resistance level right around this region here, Wes. Now, if you're holding this for a longer-term approach, I don't know what your take is on this trade, but you could get some kickback from here. So if you're looking to reinitiate the long, I'd be looking for a drop back towards this region. Okay, but remember, this is support, plain and simple. No matter what anyone says, guys, this is a 1, 2, 3 point or 3-touch support line. In fact, last night's low was an exact tag of it once again. Note that the monthly open also comes in right there, those dotted lines. So I like this support bounce, and it shifts the focus, at least in my mind, for the near term, absolutely to the upside. I think you just might get some kickback here before you start to move higher again. Okay, if we clear 1302 on the short side, or if we break below that, the last ditch effort is 1287. This is my bullish invalidation level. Remember, we've been constructive the gold trade for some time, and as we've continued to note over the last couple of months, we're treating this as a correction. And certainly the fact that the 100% extension caught the lows here does suggest that if you get a nice break to the upside, we've cleared the weekly opening range already, but if you do get a nice upside break of structural resistance, you'd basically be looking for the continuation higher. Look for the dollar to take cues here, Wes. If the dollar sells off and we do get that downside break, the upside here should be plentiful. Looking for 1355 to close. So 1355, the only problem I have with that's the high day close, critical level, Wes, 100% critical level. But the only thing I just want to tell you is that would necessitate a break of structural resistance. So you can envision a scenario where you kind of come into structural resistance and pull back and dilly-dally here before you break out. I would just hate to see you sort of miss out on closing that position on a $5 move here. So just keep that You know, this is irrespective of the slope of the pitchfork. It's just basic trendline resistance. You know what I mean? So either way you look at it, I would just watch that ahead of that 1355 target. Comes in right around like 1349, 1348. Wes says, got it. Right on, man. Says, so if it breaks 1330, should I add to my position on a retracement? This is what I would do, Wes. And again, this is just my humble opinion, brother. But if it breaks through the top side here, I would be looking for 1330. That's where I'd start to look for reentry, 100%. Yeah. But I don't want to just put an entry there and hope that it holds. I want to see a reaction off that level, and then I'll take another long with maybe a closer stop just against that low. All right. But yeah, that would be definitely a pivot I'm looking at. I mean, just look at what the market has done at that region before. If it's held, it's been a bounce. If it's broken, it's been a run. And that's exactly what I like to see at these pivots. He says, thanks, bro. Hey, more than welcome, Wes. Nice trade, brother. All right. So that is gold. A little bit out of order here, but we wanted to get that out for our friend Wes here. Dollar yen, number 3. Here we go. BOJ was on tap last night and certainly didn't deliver the aggressive plan that we were expecting. But you saw the yen kind of move on it with a big old rally against all of its major counterparts for the most part. And here's what the sort of broader trade looks like. Took us below that 101.36, 101.43 level. And guys, it's kind of coming into fruition what we were looking for as far as where to get on the long side. And if we get this drop into 123, 129, it's defined by the August low day the July low day close. Nope, the August low day close. I'm sorry, right here. The August low day close, and that is backed by the 100% extension right here of decline off the highs. So a move into this region would sort of be a nice possible level. I'd be looking for exhaustion. I'd be looking for a reaction, possible long triggers to try to fade this move. Look, at the end of the day, the BOJ did Operation Twist. If those of you who are familiar a little bit with the fundamental outlook here, Operation Twist is sort of an implementation that the U.S. Did. The Fed implemented this after QE2, before quantitative easing round 3. And it basically is an effort to sharpen the angle of the yield curve. So I just pulled this up on Bloomberg. I want to show you. So what the BOJ is trying to do, guys, is they're trying to increase the steepness of the yield curve. You can see that the yield curve starts to flatten out really hot, dramatically on the longer duration yields. So why is someone going to put in a 40-year investment when you're getting just so much more yield off of the 30-year? Long story short, Operation Twist is an effort to essentially steepen the yield curve, but they also want to keep the 10-year yield, on average, they said, unchanged. So they buy the shorter end of the yield, they sell the longer end of the yield, and this pushes short-term yields down and longer-term yields up, right? If they're selling the longer end, that drives price down, drives the rate higher. So they're in an effort to really steepen this yield curve, okay? Doesn't increase the money supply. That's why you didn't see necessarily the yen sell off, right? They're not straight up buying additional assets. There was 3 things that they could do. They could cut interest rates. Remember, although interest rates in Japan are negative, real rates are still positive. And that's because they have negative inflation. So although, the headline interest rate is still negative territory, they do have room to cut because of that deflationary problem that they have. So the easing measures that they introduced last night are not necessarily going to be straight up yen weakness. And that's why you saw the initial reaction here. While they did introduce new measures, you saw the dollar yen rally into key resistance. This was our bearish invalidation level, and slam right back into support. And again, we're looking for possible entries lower down. If this is a correction, there's the 100%. That would be a nice A, B, C type of move. Okay, if we are putting in that bottom that we think we are near term in dollar yen. Here's what the scalp looks like again, a little bit closer up on the 2-hour chart. Here's the 1-hour chart. Okay, and let me just put it on the 2-hour. And this is where we were last night. Okay, so you saw a pop into that key region and a drop. We're looking for a move into the August low day close. Still a lot of volatility likely to be on hand here for dollar yen. Don't think we're out of the woods just yet. Dollar yen specifically tends to react exceptionally strong to U.S. developments, specifically Fed developments, because of the implications on bonds. So keep that in mind, okay? So is 130 a possible area to long? Wes, I think so. I'm looking for a reaction at that level, yeah. I'm looking for the action at that level. With the same respect, Wes, if we settle the day below that, I don't even want any part of this. I'm out. Okay, so Conwall, always, I get this question a lot. And again, remember how we trade the turns. He said, for a long, where would we place the stop? So again, if it just drops into this region, I'm not blindly keeping a long order here. We're intraday scalping, right? So you'd have to wait for the reaction, the pullback, and then once we settle again, you'd put the stop against the most recent low. I'm always looking, guys, for like a 30, 25, ideally 20 pip stop. Usually on hand. I'm higher levered. I don't want to put on, you know, a 30, 50, 60 pip stop on the position sizes that I take. So I'm always looking to keep that stop as close as possible, and the best way to do that is to wait for the turn, let the market react. You're not going to catch the exact low, and that's okay. But certainly, you know, we'd be looking to put the stop against that most recent low. Make sense? He says, okay, now I understand. Cool, cool. Conwell says, hello, Michael. Thank you for your excellent market levels you provide us. It worked out well yesterday due to your help. I appreciate that, Conwell. Cheers, mate. Oil, sir, with your excellent levels along with dollar CAD. Okay, so let me just get through euro dollar and sterling dollar, okay, and we'll jump right in. Euro dollar, number 4. Here's where we're going. Any questions on dollar yen? Okay, so here's what euro dollar looked like last night. Here's what euro dollar looks like right now. You did see a certain spill lower. I'm not really interested in trading euro dollar until it comes or unless it crosses into the key levels that we highlighted in yesterday's piece. So i.e. either a drop into this region, I would be looking to fade that weakness. You know, specifically if we get some nice long triggers off that, some divergence, I'll be looking for an exhaustion low there. Or if you break 1255, in my humble opinion, I think that validates a broader shift towards 3188, which is a big level, and 3147. So right here, I honestly, guys, I kind of just want to sit on my hands. You don't even have a clean weekly opening range. You're kind of pivoting along a major critical region. This is the monthly open you see in purple. This is the weekly open you see in gray. Support, break lower, resistance. So I don't really know what this thing is doing in the near term. I don't have a clear-cut picture on it. But what I do know is you made some divergence into the low. You're heading into major event risk. And broadly speaking, on the daily chart, I do want to be long. I know this might look a little messy to you guys. I tried to clean it up last night, but I just don't want to lose any of these slopes that could still be in play. And that highlights, again, this key area of support at 1085, 1075. So if we get that drop, you know, I'd be looking for some reaction there. With the same respect, if it breaks and closes below that, sayonara. I mean, you could really see some serious euro losses. In fact, just staring at this right now. Oops. Oh, the 100's already there. Sorry. Yep. Big, big region. Okay, so I think the euro setup's pretty clear. Anyone have any questions on the euro? You know, likely to be one of your pairs that a little bit more as far as entry on the releases, not quite as like radical as you'll see with dollar yen or specifically into the yen crosses. So we'll definitely have a look at it as we get into the release. If we get that drop in 1076, 1085, I'd be looking for some near-term support. Okay, I do want to touch on Euro Key for D. D, if you're not in the room, looks like you're still in the room. Here's what Euro Key looks like. Again, I haven't really been following it. Remember, we kind of just threw this together for you the other day. I have us coming into that near-term structural support. Now remember, we don't have too many plays, or any plays for that matter, off of this structure just yet. So I can't really validate that this is like in play. But what I can tell you is those levels that we highlighted, let's see, you got some divergence into this low. Okay, the 50 line offered some play here. Well, it's a waning divergence signal. It's a waning momentum signal rather. So you definitely see that the downside's getting a little tired here. D, if you're looking, I'm not sure what you're looking to do from here, but I would actually think this thing's at risk for a near-term rebound higher. Your initial sort of levels, and just eyeing this out here, I don't like using retracements off of lows that are still within the confines of this candle because, again, I don't know this is a low, but these are the initial levels I'd be looking at. And the 618 comes in right in line with the monthly open. Yeah, I like the concept of this trade because I do like Kiwi lower, D, but I think that the euro near term might slam lower before it moves higher. So I'm kind of weary of another fake out lower before you break higher in this pair. Does that make sense? It does look like, again, I think I covered this with you earlier in the week. It does look like a nice 1, 2, 3, 4, 5. It would suggest that you're in a corrective move here. And does, suggest to me at least that you would be looking higher near term in euro key. All right. D, any specific questions? Yes, it does. Thanks. You're more than welcome. Wes, we sure can. Let me just keep track here. That was number 5. We'll do Euro Aussie real quick for Wes here. That's number 6. Okay, yeah. So we did have a piece on Euro Aussie on SB. I don't want to waste time and go look at it right now, but all the levels have been the same. Once we broke below that key near-term bullish invalidation level here, shifted the focus lower, now testing structural support. So if we take a look back here on the daily chart, it's actually a decent reaction initially here. We want to see this hold against the low that we just made for this to remain an upside bias trade. I like it. I like it on account of just one thing. Well, let me stand corrected here. That's why I like it. Whoops. There we go. So I believe this was supposed to be the opening range low, which we already broke through, so we don't need that. Or the low day close rather. But here's the 618 retracement of the advance off the lows. Here's structural support if this is in play. Remember the 50 line did catch that first tag there. So you're coming into support. Momentum coming into support. If it's going to rebound, this is an area of which I would start to look for that to happen. Questions on Euro Aus? Wes, does that help? He says, I have a long position from 147.30. Okay, so you're a little underwater on that one, right? 147.30. I would be looking for... All right, so here's what I'll say on that. 47.45, 47.60, this 15 pip range here does look like a decent pivot if you look back in price. That would be the initial area of resistance, but what I would tell you is this, Wes. The top side target that means more to me would be right back, uncannily, as weird as it seems, right back at the former bearish invalidation level or bullish invalidation level. So like 48.29 into the monthly open, which is around 48.38. This is the region of which is a little bit more of a critical resistance barrier. And if you breach there, Wes, I think you go right back into the 2016 open. Broadly, I like Euro Aussie higher. I think we're making a pretty big turn. Remember, key context of where we are in broader trend, basic trendline support off of last year's December low. Some great divergence into the lows. This does look like a near-term bottoming. So yeah, I think this is a very clear, at least for me, near-term bullish invalidation level to work with, an obvious one. And as long as we stay above this key region, I like the upside. Wes says, great targets. I think, did I answer your question? He says, great analysis. Hey, more than welcome, Wes. Cheers. Okay. So that is Euro Oz. Going right back to yesterday's reports. Let's see here. Where did we leave off? Sterling dollar. Here's what British pound looks like. So sterling continues to meander lower. I do want to see, if we can get a tag of that godforsaken 29.26 level. It's been like taunting me for the last 2 days here with these declines. This is the low day close of the year, guys. Big level, right? This is post-Brexit. This is well after the dust settled, and the low of the year that was made on July 6th, is now coinciding. I showed you this yesterday on a broader channel support in purple here, extending off the lows from, what is that, March of 2015. And that's sort of the area of support I'd be looking for initially. On the near-term chart, you even have just basic channel support also coming into that region last night. So, again, very similar scenario. If you get a jackknife, this is sterling, so expect the volatility to be really whipsaw. But if it drops past that 29.26 level, specifically maybe even 28.70 on a stretch here today, I'd still be looking to fade it, but I'd have to be really light because this thing has been pretty weak since that break last week of the ascending formation that we were in for a couple of weeks there. So ever since that drop, it's been pretty precipitous. Now you are getting, again, divergence, which we noted yesterday. Remember, this has nothing to say with timing. It's just showing that the downside is getting a little bit waning here. And if we do break this pivot, the initial topside targets would be 130.86, 130.36, and this is the level you need to beat to get the breakout. Okay, at least near term. Let me adjust that fib for you. As far as the pound is concerned, you're also going to want to take note that we have lots of BOE speakers on tap later this week. Tonight. Here are all the BOE members who are expected to speak later tonight. Okay, you're kind of stacked, so keep that in mind. Obviously, most importantly, we'll be getting comments from Governor Carney. So Mark Carney's comments will be obviously like sort of the main focus of all these speakers, but he's set to speak basically tomorrow in the afternoon there in Berlin. These times are in U.S. times, by the way, New York. Okay, a quick segue real quick just into pound yen. As we stick with the pound here, here's what pound yen is doing, also coming into a major critical area that we talked about for a while, and that's the uncovered close, the 2016 low day close right here. I'm looking for a little bit more of a support signal here. I'm not going to just try to catch a falling sword or a falling knife, whatever you want to call it. You got the momentum trigger on the daily chart on that break. So I'm very hesitant to try to fade this per se, but I am looking for long triggers in near-term momentum. I'm looking for maybe another washout on, if we get some sort of major reaction to the FOMC, But at the end of the day, if this is going to hold, sort of this is where I want to start to see a little bit more of a stringent support in pound yen. Okay, don't want to fight it yet. Wait for momentum to turn still. But could possibly be a decent play. Okay, any questions on pound yen? Six, that was number 7. Number 8. Okay, Aussie dollar looks like this, and here's what it looked like last night. D says, I have 7 minutes left to go. Any chance of looking at Kiwi dollar in the next 7 minutes? Please. Yeah. Last request for today. No problem. No problem. So that was number. Let me segue. We'll come back to Aussie in just a minute, guys. Let me get dollar. What is it? Kiwi dollar out. It's number 7. Okay. So D, here's what Kiwi looks like. So nothing's really changed from yesterday. If you guys remember, we started off the week. I know that swing trades unfortunately got whipped out on this one, but if we started off the week yesterday saying, look, as long as we stay below former median line support or former trend line support, now resistance right here, very basic. To me, it's still a break. Remember, our focus got shifted dramatically to the downside after that key reversal off of this major area of resistance, right? Then that decline, we were looking for support, that broke, and ever since we stayed below that, every single day we've tagged that thing, we've pulled off, we've pulled off, we've pulled off. So for me, I still favor the downside. I don't have any positions on myself. Personally, if you guys look at this objectively, yesterday, I don't know if you guys remember, we were sitting right there and I said, yeah, I like the short. Unfortunately, by the time I finished the webinar, used the restroom, came back, this thing had already whipped right back into that key resistance and turned over pretty heavily yesterday. So the decline came into the initial support target as we talked about in 72.90, 72.95. Again, overnight, you got another rally into that key area, tagged once more. Here's the pullback. And again, same support remains. The break below the monthly and weekly opens is what's needed to shift the downside focus to 72.80, excuse me, 72.18. This former median line here, somewhere around 71.80. More importantly, the 618 at 71.55. So the daily chart looks like. D says, I'm short 73.40. Where is a safe stop? 73. So for me, and again, this is just my humble opinion, D, if it goes above 73.60, I'm out. I mean, give yourself maybe a cushion above last week's high. So the high here was 73.64, maybe 73.66. That's tight. Yeah, D, well, again, when you get an entry like you did, that's an ideal sort of move there. You don't want to get too aggressive on it because you're heading into the RBNZ. Okay? So for me, if it breaks, and D, I'm not just saying the high because that's just the high of last week and the high of this week. Objectively, you've set the weekly opening range here. It's Wednesday. And with this last tag, it even confirms an opening range high of right around the key region that we're looking at. So if the opening range breaks to the upside, I would expect a serious run. So from an intraday trading standpoint, I would want to play this pretty tight. Now, heading into the release, D, if you're still holding this into the RBNZ, all bets are off. I would really be looking to tone down your position size because I would want to open up my stops. I would hate for this thing to wick me into finish the 618 retracement and then just all of a sudden break apart. So if you're still holding it into the RBNZ or FOMC announcements, you want to leave yourself some room. All things held constant, if we were just in a regular environment, I would have it against the high from last week. Okay? D says, okay, got it. Many thanks. Got to go. Please wish all participants good trading with the FOMC. Cheers on that. Wes, will be okay to short it? Oh, okay, ignore my... All right. Did you get that, Wes? Does it make sense? It could be a decent short opportunity if it whips into that region. But I wouldn't know if I would want to go in taking a short from this level. I think the level that D got was sort of the best Your best catch that you could have gotten so far today. Yeah, you're more than welcome. Okay, so that is Kiwi dollar number 7. Let's go back, number 8 here to Aussie dollar. Here's what the Aussie looked like last night. Here's what the Aussie looks like right now. So we broke again 75.68 to the upside. You know, you guys know where we stand. I think me and Jamie are in the same exact boat here. I want to be long Aussie. We just, we haven't gotten a pullback to allow us to get it. The ideal entry, and maybe that's the problem, we're trying to get the ideal entry, but the ideal entry was right here earlier in the week. And where would you put the stop on reduced leverage on Kiwi? Puja. Sorry, guys, to interrupt the thought process here. I'd have it above that 618. I'd have it above that 618 because look, the 618 retracement of the decline also lines up. Look on the right here of my chart to the daily. A 618 would necessitate a break of that former trendline resistance we've been checking, or former support, now resistance, but it also would necessitate a break of the high that you made for the August calendar month. So I think if you clear, excuse me, 73.80 into 73.90 here, Puja, that's sort of a region where all bets are off. I think you run right back into the high day close again. Make sense? Yeah, you're more than welcome. Guys, just give me one moment. Okay, sorry about that. So as far as the Aussie, it's a little disappointing for me because I feel like the rally kind of got away from us before we got to get in. So look, I mean, at this point, you either need to play the breakout or you need to wait for the drop. So yesterday, this is what we were looking at. And again, it's on its way up there right now. The 618 retracement of the decline. Do keep in mind you have that 50 line right now, which is giving us a little bit of a resistance. But the bearish invalidation level for the broader trade still remains 73.80.74. The near-term bullish invalidation remains right here. Okay, so if we break back below the monthly open, this trendline support, the 50 line for the current operative descending formation, that would shift my focus and actually give us an opportunity, in my humble opinion, to get a downside play into 73.80. But ultimately, I do want to be long Aussie dollar from down here if we can get that drop. Okay, yeah, you're spent on Aussie data for the rest of the week, so there's really nothing from that side of the market that's going to hit you. Really just look at dollar price action broadly here for the Oz. Wes, you're telling me, man. He says, waited forever for 73.80. You and me both. You know what? Even 74. I would have jumped in and just taken a stab with a lower leverage position at 74. 74 actually right now lined up even better with the lower parallel here of that key clear structure we've been in. Just, I just didn't want to give it to us. There's another sliding parallel actually right off that low. Caught pretty nicely. Actually, I'm going to work with that sliding parallel. I'm going to remove this, although we had that hold right there. Looks like this is a little bit more meaningful at this point. All right. Yeah, testing my patience, says Wes. Yeah, you and me both. So game plan is look for resistance near the upper parallels of this formation, a break below the monthly open. So let me highlight that for you right here. Is what would shift my focus lower, looking for 73.80, 74 as possible entries. And that's Aussie dollar, number 8. Number 9, just want to touch base real quick on Aussie yen. It's nothing I've actually placed any trades on this week yet, but just to note that it looks like we're making a break. We highlighted this key region yesterday in the webinar. It blew through it, came right back below, and here's that parallel. And if this is a break right now, which I think it looks like, we're going to look for that drop into that key region that we talked about yesterday, 75.76 into 75.90. So that's a 618 extension off the decline from the highs. That's a 618 retracement from the ascent off the lows. And if you take a longer zoom back, that very clean, very long dated median line formation gives us the median line right there as well. All right, so if the yen is going to make that final stab lower or finally find some weakness or find some resistance on the yen side, so pull back in the yen, Aussie yen might be a nice play here if we hold that 75, 76 level. With the same respect, guys, if it closes below this region, I'd be looking to sell rallies for a move into 74.21. So just a quick recap. I know someone was asking about this here in the webinar yesterday. Okay, did we cover dollar CAD? I think someone asked about it. Not yet. Okay, cool. Who was asking about that? Steve. Steve, you're still in the room. Says, I see dollar CAD bounced off of the 131.40 level for the fourth time. And Conwall, I'm sorry, Conwall was also asking about it, about oil and dollar CAD. So here it comes. Conwall, there you go. I just saw your message. So for dollar CAD, this is what I have to say. Yesterday, we were talking about the break of the ascending channel formation in the update. Here's what dollar CAD looked like last night. We were talking about this break, and I was like, look, if this is a legit break, then your first downside target right off the bat is going to be this region right here. You're looking at the opening range low for the week and a basic 236 of the ascent off the lows. Okay, so that gave you a nice key range here of 31.47, essentially into 31.35. That's exactly where this thing found a low on the pullback. So it was a tight range, but it did drop there, and now you have a very clean weekly opening range. So just like the dollar index and some of the other pairs that we looked at, for me, I'm just looking at this range right here heading into the FOMC release. My preferred move, again, if you would put a gun to my temple and tell me what do you think is going to happen right now, I would say this thing rips into the 200-day moving average, which is not too far away from where we are right here, then makes a drop lower. I still am looking for possible long exposures off this region. Monthly open, former trendline resistance, maybe even as deep as this sliding parallel. So just below the 131 handle right here. It's the same region we've been looking at for a while now. So that's sort of my assumptions, my ideal like sort of dream scenario, Conwall, for the dollar CAD. Even if we don't get the rally, if we get the drop off, I'll be looking for a reaction off this initial level here near 3080, 3070. Like I said, maybe even as deep as that former slope there. Okay, but a clean weekly opening range, just on its face, you're basically looking for, the market to close today outside of this range that we've set since the beginning of the week. Now, the implications or, the similarities here with what we're seeing in crude, I mean, this thing has been super clean, and I hope you've been taking advantage of it. I know that Conwall has. The support level that we discussed yesterday did end up being, a nice little launching pad, if you will. The 618 retracement of the ascent off the lows that you made from August, also the 50 line for the broader formation that we've been following in crude for, over a year. And you're now checking the monthly open as resistance right here. Now also on the near-term chart, you're also checking near-term structural resistance. If you remember, we added this pitchfork on yesterday, and we noted that the 618 came right in line with that lower parallel. Now you got to probe just lower in U.S. trade. Here's the rebound higher. And for the week, here's your weekly open, okay? You just broke the weekly opening range high. Now checking the monthly open structural resistance. So Conwall, heading into the U.S. session, crude is at resistance, okay? If it breaches from here, your topside target would be right here. Okay, the 618 retracement of the decline. I'd also be looking at this pivot in price, which is a swing low that you made from early August, or late August rather. That gives you 46.40 into like 46.58 as near-term resistance here for crude. But you're at resistance right now, okay? At least near term. Questions on crude or dollar CAD? That's number 10 and 11. Okay, I think that covers everything. We got gold, we got CAD. Oh, remember for the dollar CAD, by the way, we do have CPI data at the end of this week. Here's what that expectation is going to look like. We'll go over this again tomorrow, obviously ahead of the release. I'll give you another update, but retail sales is on tap. We also get CPI numbers, and the year-on-year is expected to uptick to 1.4 from 1.3%. One thing, now that we have a minute here together, what's major support for sterling? I thought we just covered that, right? You're coming into it right now. 129.26 is what I'm looking for as support for sterling, Horace. Which pairs which pairs, I think you mean, do you think will be the best to play for FOMC? So guys, on last night's updates, I gave you all the dollar crosses that are in focus for me. Kiwi's not on here because Kiwi was the update from the day before and there is no change to any of those levels. So Kiwi is still on the table. For me, the major ones I'll be looking at, to be quite honest, is dollar yen. I know that's weird coming out of my mouth. You're probably all shocked. But I'm looking for dollar yen. I'm also looking for the Aussie to see if we get that stretch into structural resistance, which might be short, or West 73.80, 74 might be a good long. And I'll also be looking to see for the pound. I do want to see if 29.26 we get a probe below that and this thing ratchets right back above. It might be a scenario like we saw the last time we probed in it last month. And it might be the onset of a nice little rally there. If the dollar rally persists and just rips face, guys, don't try to get cute because you're going to get stung. We're expecting this to be a little bit more of a hawkish tone, but keep in mind, again, the near-term price action is likely to be volatile. So if you're newer to the strategy, or if you're a little bit hesitant, or if you're a little bit unclear on what you want to do, sit on your hands, let the dust settle, guys. Once we get this out of the way, there's going to be plenty of opportunity, trust me. Adam says, Jamie's still on this afternoon? No, Adam, so we moved Jamie's webinar to tomorrow. Remember, guys, you can always go to the homepage on SB, and the webinar schedule is front and center. So Jamie's webinar is tomorrow at 1 p.m. Eastern to kind of let the dust settle before we get him on board. But one thing I did want to share with you guys is some proprietary research that Jamie and I have access to. We're good friends with this firm that launched not too long ago, which basically categorizes and catalogs all Fed and central bank rate commentary from central banks all over. Okay, so what they do is they take these commentaries that or the comments that come out, and they sort of put them, quantify them by numbers, and makes assessments based on what they think the Fed has essentially, or the central bank has essentially said. So just to go over with you, some of the stuff that we've seen as of late. Here is what their assessment is coming into today's Federal Reserve meeting. Okay, so for the Federal Reserve, they said likely to hold rates. We expect the Fed to hold rates on Wednesday to aggregate trend currently sitting below the high point reached ahead of the December 2015 hike. So they're going to be, they're still looking for them to signal a hike before the end of the year. And that's kind of what we mirrored here today in our conversation in the webinar. Don't necessarily pay too much attention to the charts. This is how they score their hawkish and dovish commentary. But what they did want to know is the last time we saw the Fed hike in December, their index was showing a much stronger hawkish tone. Okay, whereas right now we're still kind of below those levels, which means on a day like today, you'd expect to see them up their hawkish rhetoric, right? They really need to start to ramp up expectations and signal more clearly to the market that, hey, things are going to tighten soon. Okay, and with this is the forward guidance that essentially gives the markets the clarity of, okay, this is what we should expecting from the Fed. Is this part of IDO? No, this is another company called Prattle. You guys can definitely check them out online. They do a lot of institutional accounts, so certainly it's been something interesting for us just to kind of take a look at. We're not really huge on wasting too much time on the fundamentals, but with that said, this is kind of a nice thing that we just kind of gauge before each release. Obviously, they're expecting them to hold rates, amend the bond purchases. That's what we got. Operation Twist, essentially, again, with the buying of shorter end yields and the selling of the longer end of the curve to kind of steepen the yield curve, generally speaking. New Zealand heading in today, they're expected to hold rates, soften inflation data. Soft inflation data and strengthening currency might point to a rate cut from the RBNZ, but the bank's gradual rise in sentiment coupled with encouraging economic data suggests a hold this week. And that's something, again, we talked about earlier today. They are expected to hold the RBNZ interest rate decision, but we're expecting further rate cuts down the line. So if we do take a quick look at what the overnight index swaps are showing for New Zealand, okay, you can see that heading out into February, heading out into March of next year, the probability of a cut really starts to surmount much more substantially than it does for tonight's rate cut, or tonight's rate decision, which is only looking at a 14% probability. So kind of mimicking, what the overnight index swaps are showing, also showing Prattle, similar expectations. Okay, so I'll bring this up when it's pertinent. As always, feel free to take a snapshot, guys, of any of the screens, or if you want to keep this for future reference, but something we'll reference where needed. Okay, and I think that's all I've got for you, in case you're not sick of hearing me speak just yet. Good luck for everyone who's going to be trading the event today. Again, 2 p.m. is the release, 2:30 is the beginning of the presser, about 2:10 or 2:05 once she gets through the initial statement, we'll get the we'll get the back and forth with the presser, the subsequent questions, and the Q&A with the audience, which again, a lot of the devil's in the details there. Remember the dot plot, okay? So I put this there for you in the report. Reference this back and just keep this open when the release comes out and see what kind of shift we have to the 2017 outlook. This is really what's going to drive data. The link I sent you also has the link for this, which is last month's projected income or projections, last quarter's projections. And remember, we saw them downgrade GDP projections last month. Okay, this is the March projection. This is the projection that we got back in June. You can see that the March median projection dropped for GDP from 2.2% to 2.0%. 2017 dropped from 2.1 to 2.0. Okay, they even dropped their central tendencies, which is like the targeted range. As it pertains to inflation, interestingly enough, they actually did uptick it. We saw June an uptick from 1.8 to 1.9 expectation in 2017. So basically what that means, guys, is if we see them today come out and again downgrade their inflation targeting. Remember, they were getting a little bit more rosy, and certainly we did see that the core CPI numbers came out last week were actually stronger than expected. So if this picks up, if we see an uptick in GDP, employment is sort of where they want already, near central tendency, look for the dollar to maybe get a near-term pop. And again, that might be their suggestion, a little bit more of a tell that yes, the FOMC is ready to move on rates sooner rather than later. Okay, not going to be your easiest trade by any means because these central bank rate decisions are all about the details, but we'll try to keep you updated on SB Squawk. Stay nimble, guys. Keep the leverage to a minimum until we really get a little bit more clarity and the dust settles. And as always, we will try to keep you updated on our end. Best of luck trading, and I'll see you guys bright and early tomorrow morning, 8:30 Eastern, for another session. Cheers, guys.